guys. I know it's been a couple of days since I've done one of these, but it's been a bit of a roller coaster week, and my attention's been dragged elsewhere. One of those things was this the award that we received from Global Finance magazine for the best new trading firm in Australia, which we're very proud of. So I just want to reiterate that what we're doing, and obviously our clients appreciate everything that we are doing. So let's go and have a review of what's been going on. We've had, I guess, the key parts that I'd like to talk about is Australian inflation and GDP. Yes, inflation ticked off a little bit, and GDP also ticked off, and that's all due to interest rates rising. But it also means we're closer to a recession. Just going through this article from the Fin Review this morning, talking about the GDP and how it's affecting households. And remember that consumer spending is around, in most economies, between 50 and 60% of GDP. So we've gone from a 5.9% GDP down to 2.7, which is a big drop in a very short period of time. Wage growth hasn't prevented disposable incomes from falling, and we can see also as the interest payments as a share of the household income is rapidly rising after all the millennials complaining about it being super expensive. It did get down quite low, similar to what the Gen X's or baby boomers experienced, but it is rapidly increasing again thanks to the interest rate rising, and that in turn is having an effect on household savings, and obviously the GDP in terms of being able, disposable income, people spending their disposable income more is going into the mortgages than into actual spending on the economy, and therefore GDP is shrinking, and with interest rates continuing to rise with as they try and battle inflation, it's going to tip the economy into a recession, and that's not a bad thing, right? Everybody seems to fear a recession. Yes, there'll be job losses, and yes, things will get tighter. But there's that saying, what is it? Hard men create good times. Good times create soft men. And that's where we are now. And soft men create bad times, and that's where we're heading. We haven't had a decent leader in this country or even globally for a long time. So we've had all these soft, crazy people leading the global situation, and soft men create hard times, and that's what we're heading for. And I think last time we had difficult times was 2007, 2008, and they just put a band-aid over it by creating quantitative easing, and all that did was just shift all the wealth from the middle class into the upper class, and so that really didn't fix the issue, and you had a lot of zombie companies surviving that shouldn't have survived, purely because they were getting free cash or cheap cash, rather than looking at their business operations and saying we shouldn't really be operating because we can't afford to, and what we're producing is not wanted. So there's that situation. So that's happening here in Australia. Further afield, there's been let's go through Tyler Durden's, right? So a couple of Feds were talking that interest rates need to be at 5% or 5.5%, as the macro data continues to strengthen, showing that inflation is not under control. There's now talk of 6% interest rates, and inflation coming out of Germany was hot, and also Chinese PMI data. It's manufacturing index as the survey, so I don't put a lot of weight on that, but it was interesting to see. Treasuries were ramping higher, and we've got the 10-year topping 4%, which is the highest since November. Inflation, which is when it started to tick off. Terminal rate now 5.5%, so no rate cut this year. Over in ECB, that's looking at 4% as well. US dollar was dumped on the Chinese PMI data, but we'll talk about that in a minute. Bitcoin getting smashed into the close. Oil all over the place with inventory data, obviously being a little lower, so it puts a supply and demand issue. Financial conditions have started to catch back up to monetary policy, and which suggests the macro data is soon going to surprise to the downside. So macro data is the hard data, things like inflation, jobs, and all of that, retail sales, not the surveys and stuff. So when they start to surprise, you'll get, we're going to have interest rate cuts, and that will make stocks and bonds rally, which will loosen financial conditions until they realise, well, no, that's not happening, rinse and repeat. Tongue in cheek there, but in reality that's kind of what happens. So let's go and have a look at price action. As we can see here, US bonds are in a pretty strong uptrend, as in inflation is not being curtailed, and we're looking at now sort of interest rates peaking around 5.5%, maybe even 6%. Bonds need to catch up to that. I expect that trajectory to continue. Obviously not in one direction, you're going to have pullbacks and retracements, but that's the direction the trend is going. Looking into, let's have a quick look at commodities. We're seeing gold spike a little bit, oil up a little bit, wheat is, well, it's crashed over the last couple of weeks, but it seems to have stabilised. Copper bouncing again, and that's off the Chinese data. I wouldn't say the global economy is really ready to sort of be in a growth situation. I think growth is still contracting, but China might lead us out of it. I doubt it, because you never know what's going to happen with China, because their data that they release is always subject to scrutiny in terms of is it real or is it just doctored to make them look better, which they're renowned for doing. Over in stocks, we've got VIX, which is the fear indicator, pretty much flat for the last week, which is a bit surprising when you're seeing stocks come off and continue to come off. They've been sort of weakening now for a better part of 3 or 4 weeks, and I would expect that to continue as interest rates continue to bite, and as interest rates continue to sort of have an effect. I don't put much weight on trend lines, or the break of it. In reality, your technical indicators are only as good as the fundamental analysis, because if a figure comes out like, interest rates are going up 1%, the market's not going to stop at a trend line. It's not going to stop at a Fibonacci. It's not going to stop at a horizontal line. When news drives and sentiment drives price, that's going to blow your indicators out of the water, and that's your momentum indicators, Bollinger Bands, whatever indicator you've got, right? Price action indicators are only as good as price action driven by the fundamentals. So you might see a trend line here and go, oh look, there's a good buying opportunity. I don't think that's a smart idea. Aussie stocks also been in a strong downtrend for a month. Also got a bit of a trend line support there, but I wouldn't hold much debt in that. Yes, you do have cycles here, but it's come back and gone below that. And it's now sort of found a bit of a support line, maybe looking at that level there. Aussie 200 loves round numbers, so 72.00, and you can see that it bounced off that and has held that for a couple of days. Market will lean on that 7200 level, and the Aussie stock market, particularly the futures, which this index is based on, loves leaning on round numbers. Dollar index, I told we were going to talk about this. Yes, it's come off thanks to Chinese data, but I'm looking at that as a reason to get long. This is the retracement, burning off our momentum indicator, or the heat in it, which should give us an opportunity to get long. It's just a matter of finding a decent support level to lean on, and have your stop loss level hidden. So you have your stop loss here, and you look to be a buyer here when the market starts to bounce. You don't just buy at that level. When you see the buying coming in, you go, okay, that's a good enough indication, similar to what you would do in there. You see the buying come in, you go, all right, let's go with it. So that's what we're waiting for. Fundamentally, I don't think it's a seller's market in the US dollar. I think it's still a buyer's market. All the indication of a safe haven flow from stock market sell-off to interest rate rising. You've got plenty of reasons to be buying US dollars. It's just finding the technical picture to match the fundamental picture. So we're waiting for that to happen. Looking at Aussie dollar, downtrend, looking for similar to the US dollar, but just in reverse, looking for an ideal situation and scenario technically to be a seller, and finding that not right at the moment. Same thing with euro. Happy to be a seller, just finding that ideal scenario. Might be off somewhere around here. So if we can get short somewhere around there, might even be off where we are right now. But that one looks like a better level. So just waiting for that sort of the market to present itself. And dollar yen, pretty strong uptrend. There's looks like a great opportunity there on the 4 hour. On the 4 hour chart there, it looks like a reasonable opportunity. It'll be then your stop losses here, your entries here, and what you're then running a risk reward ratio of say 1 to 2. Where does that put my target, and is that going to likely to be achieved if there's a major resistance level between my entry and my target? Rightio, I think that'll do us for the day. 13 minutes. Wow, that's a long one. I do apologise, but yeah. Happy days for winning the award, and I'm sorry it's been so long since we've come back to you, but hopefully things will settle down now. New month, and we'll see you tomorrow.